We will continue the discussion on the chapter Fire Insurance Claims. Today we will discuss the topic average clause in fire insurance. What is average clause? Average clause. Average clause. What is average clause? That is, suppose the policy amount is rupees 1 lakh, and in the memorandum trading account, if you get the stock at the date of fire, the stock destroyed by fire, rupees 1,50,000, there is a case of underinsurance. What do you mean by underinsurance? The policy amount is less than the stock destroyed by fire. In that case, insurance company will not give you the entire amount of loss. Then in that case, it will give proportionate amount of the loss. What do you mean by that? That is, if an average clause is included, the claim amount is calculated as follows, like this. That is, sum assured, that is policy amount, divided by stock at the date of fire into actual loss. Stock at the date of fire into actual loss. This is how claim is calculated under average clause. An average clause is usually included in fire insurance policy, and in your examination problem you have to apply average clause if the policy amount is given. If the policy amount is given, you have to apply average clause even if it is not specifically mentioned in the problem. Now let us discuss this topic with an example. Suppose a fire has broken out in a business, and as usual you are preparing a memorandum trading account to find the profit, the stock at the date of fire. Then the opening stock, suppose, is 50,000. The purchases up to the date of fire, say for example, is 1,20,000, and sales up to the date of fire is 1,40,000, and GP is, suppose, 20% on sales. So to gross profit, 1,40,000 into 20 by 100, you get 28,000. Then you find the stock at the date of fire, like 1,20,000 plus 50, 1,70,000, 1,70,000 plus 28, 1,98,000, and 1,98,000. You get the balancing figure as 58,000. This is the stock at the date of fire. This is the balancing figure. And you have calculated the stock at the date of fire as usual. Now let us see how will you apply the average clause. Suppose the insurance policy amount, is for rupees 80,000. And stock at the date of fire is, as we have ascertained, 58,000. So the policy amount, here the policy amount is 80,000, stock at the date of fire is 58,000, policy amount is more than the stock at the date of fire. So there is no necessity of applying average clause. When will you apply average clause? Suppose, so no need of average clause. Suppose policy amount is 30,000 and stock at the date of fire is 58,000, then in that case policy amount is less than the stock at the date of fire. Then you have to apply average clause. How will you find out the average clause? Suppose in this case there is a salvage of, for example, 3,000. If salvage of, suppose 8,000, salvage of 8,000. In that case, so actual loss is 58,000 stock at the date of fire less salvage 8,000, then you get 50,000. 50,000 is the actual loss. And how will you apply the average clause? Average clause is applied like this. Average clause. When you apply average clause, claim under average clause is calculated as sum assured or policy amount divided by stock at the date of fire into actual loss. Here the policy amount is 30,000, stock at the date of fire is 58,000 and actual loss is 50,000. You get an amount, that amount is the claim to be submitted. And this is how average clause is applied in the case of fire insurance policy. I hope you understand the concept clearly. Okay, right. We will meet in the next class.